Stan, could you briefly discuss the kind of four different stages within a stock's life cycle and also how you kind of differentiate between them?
Sure. I think that's a relevant thing. And it's so straightforward and it sounds almost too easy to be really a success part of the equation, successful in the market. But here we go. Stage one, a stock. Let's use numbers just to illustrate what I'm talking about. A
Sure.
stock has had a big decline, Richard. It's fallen from, let's say, 25 down to 8 over many, many months. It's been bad. Now it starts to finally dig in and build a base. And just like a house needs a foundation, a stock before turning around, people think, oh, if I catch the bottom, it'll maybe go up. That's just a short-term wiggle and jiggle. A stock needs to build a base, a
Right.
foundation before it starts to advance. So we go into stage one. It starts to move sideways, but let's make believe now it's going between $8 and $10. And let's use a 200-day moving average. And let's say the 200-day moving average is still like at 14. Even though the base has started, you're still too premature. You want the 200-day MA to be close to the base. Now
Hmm.
it's a couple of months later. It's still bouncing back and forth between 8 and 10, but the 200-day moving average, let's say it's at 10 and a half.
Hmm.
Now you're ready to talk turkey. It's in the stage one base. Boom, it breaks out not only above the resistance at 10, but it also now goes above the 200-day moving average at 10 and a half. You've
Hmm.
completed the base and gone into stage two, which is the advancing phase, and that's the ideal time to enter a stock. Interesting enough, when you're still in the base, the news will usually be bad,
Right.
but it's no longer going down on the negative news. That's a positive indication. Now you're in stage two, and obviously stocks don't go straight up. But let's say over the next 6 to 9 months, the stock goes from 10 to 20, and you have corrections along the way, but all of the short-term corrections happen and hold above the rising 200-day moving average. Short-term wiggles and jiggles aside, you're still in stage two. It's great.
Right.
Eventually, now let's say it's a year later, the stock has gone back up to 20. It starts to roll sideways between, let's say, 20 and 22, and the 200-day moving average is maybe 19 and a half. You moved into stage three. Interesting enough, Richard, at this point, the news will usually be good because
Hmm.
there's a reason why the stock had this big move. Now people first pick up the Wall Street Journal and other newspapers and say, oh, everything is terrific, and they'll buy it. That's a mistake. The stock is no longer going up on the good news. You're now the mirror image of stage one, where the
Hmm.
news was bad, but you didn't go down. It was basing. Now the news is good. It's no longer going up. It's rolling sideways. You're in stage three. You start doing reducing to make it simple. Eventually, you break below that floor of support at 20. You break below the 200-day moving average, which is close, let's say 19 and a half. You've gone into stage four. At that point, irrespective of what you think fundamentally, I'm a seller. I think now you've seen the high for the cycle. And if you look, well, obviously it's not perfect. There's always going to be one or two exceptions now and then. In general, when you study charts, you'll see this pattern repeats over and over again. And
Right.
if people learn how to play it, I'm not going to be facetious, say it's easy, but the market becomes straightforward and much more profitable.
Absolutely. And in your book, you talk about the ideal buy point for both investors and also for traders. Could you talk about what those are and also what you're looking for in terms of volume, price action right at those levels?
You've obviously done your homework, Rich. You're doing a great job leading me. So here we go. After, like we just said before, the stock, when it was in stage one, I have some of my institutions, and that's basically what it says, institutional product, although I do have some high value net worth individuals also in here. But basically, institutions, because they're not buying an odd lot or two, they'll start doing early accumulation, knowing they're early while it's still in the stage one base, but never when it's still in stage four.
Right.
Then eventually, as you just alluded to, you break out, you go topside above the 10 and a half. It's going to stage two. That's the ideal time both for traders and investors to buy. But now we're
Hmm.
going to become even more sophisticated. If a given stock breaks out into stage two, it's kind of like eggs. They're not all of the same quality. All breakouts are not of the same quality. So let's say chart A breaks out. Yeah, it's good. It moved into stage two, but the volume doesn't pick up. That's probably just going to be a so-so stock, and you don't want to do aggressive buying there. Conversely, we have stock B, which not only broke out above its resistance at 10.5. But in addition, the volume picked up significantly. And I like to see at least twice the normal volume of the past 30 days.
Right.
That's a good sign. And even better, in some cases, it'll be triple the volume. A stock that breaks out in heavy volume usually has a tiger in the tank. And those are the ones that, again, we're playing a probability game, never guaranteed. Those are the ones that'll usually end up being the big winners. And now I'm going to give you a subtlety, a third
Hmm.
one, which I wrote in my book many years ago. If those two things happen, but we're still going to become even more finely tuned. One is in just a so-so group, and another, which we should talk about later in this interview, another is in a hot group.
Hmm.
I'd always go with the one in the hot group. That puts all of your odds in your favor.